Hi everybody, my name's Griffin Bridgers. Welcome back to the basics of the portability election. In this part 7, we're going to continue this series with a look at some gift and GST tax strategies surrounding the use of the deceased spousal unused exclusion amount, or DSUE for short. Before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And before we get started, a quick announcement. One of the things that has long been on my mind is, what is the next iteration of everything I'm doing here with this channel, the videos, speaking, and teaching? And I've decided to take the plunge with a legacy idea I've had for a while, which is to start my own annual estate planning and tax symposium. So tentatively, it's going to be called the Western Wealth Transfer and Tax Symposium, and what I'm circling as our first annual meeting date will be November 8th and 9th of 2023. This will be an online-only type of event, at least for the first couple of years, and I'm circling right now probably around 11 continuing education credit hours for attorneys, advisors, CPAs, a variety of professionals. So still working on that angle, but if you're interested, definitely reach out and please stay tuned for more. I'll continue to develop that and promote that through these videos and my newsletter, which you can find at griffinbridgers.substack.com. But jumping back to our material, last time in part 6, we kind of looked at a very, in some parts, in-depth analysis comparing traditional A/B planning to the use of portability. And what we ended up with is kind of a balanced scale that can tip one way or the other when we compare the estate tax cost of an estate exceeding the exclusion amount versus the income tax cost of getting or savings, I should say, of getting a step up in basis, and vice versa. So I'm going to continue that thread a bit more because there are some loose ends I feel like I didn't do a good enough job tying up last time, as a prelude to looking at gift and GST tax strategies for the DSUE. Again, when we see this acronym DSUE, DSUE, that stands for Deceased Spousal Unused Exclusion, which is what's preserved through the portability election. So you're going to see that acronym a lot. We're going to talk about it a lot, so that's what that means. So, comparing again the AB-based plan and the portability plan, remember that the common question between the two is whether there's a second step up in basis, and especially, can we get that second step up in basis without wasting exclusion? In other words, are we reintroducing assets that were previously shielded from estate tax to the gross estate, again using exclusion? And the idea behind that is, typically it's not a good idea to use two different taxpayers' estate or gift tax exclusions on the same assets. So to kind of continue that thread of this second step up in basis, I feel like this illustration does a better job of illustrating kind of the zeitgeist of the last discussion in part 6. Now you can imagine this as two separate plans on the left and right, or you could imagine it as one large plan with different components. But really what I want to emphasize here is, when we're looking at AB versus portability planning, kind of the centerpiece is this idea of a QTIP elected trust or a spousal gift that defers estate tax until second death, against which the survivor can use their own applicable exclusion amount, which includes their basic exclusion, currently $12,920,000, plus the DSUE, if any is preserved. So before the DSUE, the only way to preserve the unused exclusion of the first spouse to die on the left was through a credit shelter trust. However, through the DSUE, we can now imagine that as having its own corollary or equivalent over on the right. I've drawn a dashed box because it's not really a trust, but we're going to envision that as a phantom credit shelter trust through the DSUE that doesn't actually have to be funded The first spouse to die doesn't have to actually have enough assets to fund that in full, thereby reducing that issue, but with another added benefit here that we haven't really considered. Each of these lines, if they're green, represents a step up in basis. The one red line illustrates a situation where there's no step up in basis, and that red line extends from the credit shelter trust. So the big benefit with portability is that through the use of that phantom credit shelter trust, we get a second step up in basis, but with still a lack of estate tax attached to that. So how do we get that? How do we get to this outcome, assuming too that the QTIP trust in the middle is included in the surviving spouse's gross estate and also gets a step up in basis and doesn't itself become a credit shelter trust equivalent? So ultimately, what the portability election does is it creates kind of a mega exclusion amount in the hands of the surviving spouse, consisting of the basic exclusion amount plus the DSUE. And as we'll reintroduce later, that could include multiple DSUEs potentially depending on gift tax use. So this mega exclusion is essentially going to give us a mega coupon for a second step up in basis, at least through the end of 2025 when we have the sunset of the basic exclusion amount. Now, the effectiveness of this will be reduced if that sunset does indeed occur. So that's one wild card we have in here, the other being the GST tax, as we'll look at later. And it's important to note too that the DSUE is not indexed for inflation. So while you get estate tax-free growth in the credit shelter trust, that phantom credit shelter trust in the form of the DSUE is static in amount, and effectively due to inflation, its value goes down over time. So down the road, it might not be worth as much as it is today, but it's also important to note that the benefit of a second step up in basis has the greatest utility when we compare it to the effective estate tax rate, as we looked at last time. So typically the longer the surviving spouse outlives the first spouse to die, the greater leverage you get when you compare that effective estate tax rate to the potential income tax savings from a step up in basis. Because back here, if there's an immediate death, there's really this second step up in basis does you no good, because the second step up in basis is designed to wipe out appreciation that happens after the death of the first spouse to die. So against that backdrop, typically when we look at this overall picture, lifetime gifting is typically used to remove that future growth from the gross estate to avoid subsequent estate tax and freeze the value of assets, but with the loss being that second step up in basis, or even a first step up in basis. So because of that, it's typically best to gift high basis assets if you're looking at lifetime gifting strategies. Now, with the sunset looming of the basic exclusion amount, there's kind of another objective here, which is the idea that you can use your basic exclusion now based on new anti-clawback regulations before it sunsets and still get credit for that 1/2 amount that will go away. But to get there, where that works best is if all of your basic exclusion is used for a lifetime gift. Now, it has to be done in a way where the amount that is used for a lifetime gift isn't subsequently tied to assets that are then included in the gross estate, because there's a new round of regulations that look at that as being abusive. So in other words, if you gift away assets during life to use your exclusion, but then they get pulled back into your gross estate, you won't get credit for the use of that basic exclusion during life, and you'll be forced to use the smaller basic exclusion that is in effect post-sunset, if the sunset does indeed occur. But with that second round of proposed regulations, there's an important distinction that we should know. It only applies this abuse rule to the basic exclusion that's used during life. It doesn't apply that abuse rule to the DSUE. So the DSUE could be used potentially, as we're going to look at a little bit more, for gifts possibly in trust that will intentionally be included in the gross estate of the surviving spouse. Now, why you might want to get there as opposed to just using a credit shelter equivalent is, again, that second step up in basis, and we'll look at that a bit more as we go along. But the catch here, too, is that the basic exclusion of the first spouse to die is used last. The DSUE has to be used first under the gift tax and estate tax regulations. So, if the surviving spouse wanted to plan for the sunset to use their basic exclusion, they couldn't actually do so until the DSUE is exhausted. So, this may be a reason to not actually use this portability plan and instead pursue AB planning. But if it's too late, if you're already down this road, what options do we have here? Does this mean that the survivor has to have enough assets to fund not just their DSUE, but their entire basic exclusion in order to leverage the use of basic exclusion before the sunset? In other words, does this mean that the spouse has to forever give up access to those assets? The answer is it might not. So, typically, when you gift assets, you lose access to those assets with the idea that they will not be included in your gross estate and won't get a step up in basis. However, since the DSUE is not subject to the new proposed anti-clawback regulations, which mandate that you can't have it included in your gross estate or subject to a step up in basis, we have the potential, if you want to call it a loophole, that a surviving spouse could create a completed gift trust that uses the DSUE if they need to get to their basic exclusion amount by gifting away enough to use up the DSUE first. And they could keep that DSUE trust in a form that will be included in their gross estate. So that could be in the form of, let's say, a grantor retained income trust or a GRIT, in which the surviving spouse would retain an income interest, possibly with other beneficiaries having interests as well. But it's important to note that this trust may not be creditor protected depending on the state. Now, that aside, this is more of a tax-focused discussion, but I'm going to coin this type of trust the DSUE GRIT. So the DSUE GRIT really has two distinct benefits here. One is that the surviving spouse gets to use their estate tax applicable credit for the amount gifted into the trust, regardless of whether they retain an interest in it. So they still get credit for the DSUE applied as applicable gift tax credit. And then we also get a second step up in basis through that DSUE GRIT, because the GRIT feature means it will be included in the gross estate as well. But the cost and catch beyond the GST tax, which we'll look at later, is that any growth in income, whether it's distributed or undistributed, will increase the estate tax base of the surviving spouse. So that future growth in income will be subject to estate tax if not consumed by the surviving spouse, and the surviving spouse may not have enough DSUE or basic exclusion to offset that increase in estate tax. However, because the DSUE GRIT is a grantor trust and because it's included in the gross estate, we can do something here that we can't do with other trusts. We could gift in low basis assets because we get a step up in basis for a completed gift trust. And we could also use this as a mechanism to do tax-free swaps of low basis for high basis assets as well. So here's a quick illustration where we look at what this looks like, where we've replaced on the right our phantom credit shelter trust with the DSUE GRIT. This is a trust funded during life, typically using the surviving spouse's personally owned assets and not necessarily assets from the QTIP trust, as we'll look at later, because that may not be efficient from a GST tax perspective, or even from an estate tax perspective for that matter. But ultimately, what we have to do here when we look at the estate tax benefits is split these out into two paths. One, we have the QTIP trust and the surviving spouse's estate that's not gifted, and those will typically be subject to estate tax on amounts over the basic exclusion amount, assuming the DSUE is used in full to fund this DSUE GRIT. And then on the right, we'll have the DSUE GRIT being subject to estate tax on any growth over the DSUE that was actually used to fund that trust. Any DSUE not used could actually carry over and offset first any estate tax against the QTIP trust or the surviving spouse's assets. But the idea here, again, is that our second step up in basis is preserved through all these trusts. So for this to make sense, as we learned in part 6, the effective estate tax rate has to be less than the potential income tax savings to be achieved through that second step up in basis. So when it comes to gift tax reporting for the DSUE itself, since we have to use that first for any lifetime gifts by the surviving spouse, it has to be reconciled on the gift tax return, Form 709. You have to report that to the IRS. You can't hide it and try to use your basic exclusion amount first. So on the Form 709, there's a Schedule C on which you have to report the DSUE not just from your most recently deceased spouse, but also potentially from previously deceased spouses if you've been widowed multiple times. Why? Because you can get credit for amounts that you actually use as gift tax applicable credit from those prior deceased spouses' DSUEs, as we looked at in a prior discussion. So what we do here is use Schedule C to add up on Part 1, the DSUE from the last deceased spouse, which we get full credit for, and then on Part 2, the DSUE from predeceased spouses that was actually used for lifetime gifts before the death of the most recently deceased spouse, which you can see on column E. So we add up all of those and add on the bottom, on line 1, the donor's basic exclusion amount, and essentially this is going to add up to give us, on line 5, a box which gives us our applicable credit, or I should say our mega applicable credit from the DSUE and basic exclusion, which can then be carried over to Part 1 on page 1, where we enter our applicable credit amount on line 7 to offset the tentative tax on gifts for the current year. So, with that mega applicable credit, if a surviving spouse remarries, we've looked at the fact in the past that they can only preserve their basic exclusion amount for their new spouse as a DSUE for that spouse. So what we've been looking at so far is somebody who's been widowed multiple times. What happens if they remarry and they are actually the one whose time is up? So they can preserve their basic exclusion amount, but they can't be a conduit for DSUE. They can't preserve the DSUE that was preserved for them for another surviving spouse. But nothing stops them from using that DSUE, which is reflected in this mega applicable credit, on a trust that might be for the benefit of their new spouse, and which doesn't qualify for the marital deduction. Why? Because you can't actually use DSUE on a trust if it qualifies for the marital deduction. But that aside, this use could include, for example, a credit shelter trust funded at death for which their new spouse is a beneficiary, or even a SLAT funded during life for which their new spouse is a beneficiary. And if it's a SLAT funded during life, as we looked at above, it could even be set up as a DSUE GRIT, where the surviving spouse could maintain an income interest to get that second step up in basis as well. But that DSUE GRIT would have to be funded only using the DSUE. Any use of the basic exclusion to fund that GRIT may be abusive, and the cost would be that the 1/2 portion of basic exclusion that might sunset that is used for that lifetime gift may not be applicable as a credit against estate tax as part of this mega applicable credit at the surviving spouse's death. So, giving this a better look, what we have now is our unused DSUE, or the DSUE GRIT, still in the phantom credit shelter box, but the idea now that our remainder gifts are really taking on the form at the surviving spouse's death of being a mega credit shelter trust for family members, or even for a spouse by remarriage. So the spouse by remarriage could benefit from the DSUE in that remainder interest trust, but could also benefit from perhaps a use of DSUE during the surviving spouse's life for a SLAT or a DSUE GRIT. So you have two options here as to where the spouse can benefit. So in that grand scheme of things, one issue that's kind of flown under the radar so far, but is helpful to illustrate graphically, is what do we do about the GST tax? And is there a way to preserve that in the grand scheme of things? Now, what we learned so far is that portability doesn't preserve the unused GST tax exclusion of the first spouse to die. However, there's a catch, and this is more meaningful than it seems at first glance, in that we can preserve the GST exemption of the first spouse to die in a QTIP elected trust if a reverse QTIP election is made. Now that's significant because the QTIP trust has to be included in the gross estate of the surviving spouse, or if it's gifted during life, it's subject to inclusion in their taxable gifts. In either of those scenarios, typically it would keep the first spouse to die from applying GST tax exemption, and it would force the surviving spouse to use their own GST tax exemption for that portion of the QTIP. But because of the reverse QTIP election, it means that for the same portion of the QTIP, we could use the applicable exclusion amount of the surviving spouse, not the first spouse to die, but the surviving spouse, because of the marital deduction. But we can flip the script and say that the GST exemption of the first spouse to die is used for that portion of the QTIP. So graphically, what does that look like? We'll look at it in a minute. But before we get started, I want to note this regulation that kicks in with respect to the reverse QTIP election. And it basically says that a QTIP trust that's been subject to that reverse QTIP election is going to keep the identity of the transferor without looking at sections 2044, 2207 Cap A, or 2519. What does that mean in the grand scheme of things? What it means is that, I alluded to this earlier, if GST-exempt assets are subject to gift or estate tax in the hands of another person, typically that means the new person becomes the new transferor. So that wipes out any prior application of the GST exemption of the prior transferor and wipes out the GST-exempt status through resetting the inclusion ratio until the new person who's subject to gift or estate tax can apply their own GST tax exemption. However, this regulation exempts that deemed shift of transferor that could apply to a surviving spouse for a GST-exempt QTIP trust under code sections 2044 or 2519 if there's a lifetime gift from the QTIP trust. So for example, if the surviving spouse used the QTIP exempt or the GST exempt QTIP trust to fund a mega credit shelter trust or a DSUE SLAT, it could still be GST exempt, which is kind of a neat trick that a lot of people don't consider and don't really look at. Now, when it comes to a DSUE GRIT, that may not be effective because note that the regulation here bypasses 2044 and 2519. What it doesn't bypass is code section 2036, which is what might apply to the DSUE GRIT. So even if the DSUE GRIT is GST exempt during the surviving spouse's lifetime, that exemption wouldn't continue beyond the surviving spouse's death. At that point, the surviving spouse would have to use their own GST exemption against that DSUE GRIT, which might be a bad outcome. So looking at this graphically, we can imagine the QTIP created at the death of the first spouse as being a two-parter, potentially. It could have a GST exempt portion and a GST non-exempt portion. For the GST exempt portion, the reverse QTIP election will have been made. And the idea is that the GST non-exempt would be the portion that exceeds the GST exemption of the first spouse to die. Now, from an estate tax perspective, the combined assets of the QTIP trust and the surviving spouse's assets will use the surviving spouse's applicable exclusion, which will be their basic exclusion plus the DSUE. However, at death, this GST exempt QTIP could continue on as a GST exempt SLAT or credit shelter trust for surviving spouse or I should say second spouse of the surviving spouse. But we have the ability for the surviving spouse to apply their own GST exemption to the red box, the GST non-exempt QTIP, which then funds itself into another segment of that GST exempt SLAT or credit shelter trust. And then ultimately, the phantom credit shelter trust wouldn't be GST non-exempt. It would be funded through the DSUE, but it could pour over into a GST non-exempt SLAT or credit shelter trust, which could be offset by the basic exclusion amount or the deceased spousal unused exclusion or some combination thereof for estate or gift tax purposes. Now, any of these types of trusts are ones that can be funded during life or at death, but ultimately this shows how the GST exemption can still be leveraged. So if there was an outright gift to a spouse, the GST exemption of the first spouse to die could not be preserved. But by using a QTIP structure that funds it sufficiently to use the GST exemption of the first spouse to die, we can have this GST exempt QTIP that leverages the first spouse's and the surviving spouse's respective GST exemptions to create an outcome that's similar to what we'd have through the portability election. So ultimately, everything taken into account here, there's a lot of income tax leverage to be obtained through the strategic use of the DSUE to create that second step up in basis through a mega exclusion. Now, continuing that on, we end up in a situation where lifetime use of the DSUE has to be accomplished if the surviving spouse wants to use their basic exclusion pre-sunset. But the difference is that that DSUE can be used on a trust that will be intentionally included in the gross estate of the surviving spouse, which again subjects future growth to estate tax, but gives a second step up in basis anyway, and allows a gift of low basis assets as well. And why might we do that? Well, depending on funding source, especially if it comes from a QTIP trust, we may not be able to create a GST exempt trust in the form of a DSUE GRIT, but we could through a DSUE SLAT. And even though we have unused GST exemption not being preserved through portability, that reverse QTIP election through a QTIP trust can create a GST exempt share that carries on with the ability to subsequently allow the survivor to allocate their own GST exemption to the non-exempt share. That's something that wasn't attainable if we simply made a partial QTIP election at first death. So ultimately, a full QTIP election will create this GST exempt status leverage, which will create a great segue into our next discussion, a deeper dive as to how the QTIP election factors in when we're looking at portability. And then finally, the last installment in this series will be whether the surviving spouse has to be a U.S. citizen in order to apply the DSUE. If you're a tax or estate planning practitioner and you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. And if you have a need for a speaker for anything that you have coming up, programming-wise, estate planning councils, bar associations, so on and so forth, feel free to reach out and keep posted for further info on the Western Wealth Transfer and Tax Planning Conference that I have coming up. Thank you again for listening to this video, and I look forward to seeing you in my future content.